and I want to help you live your best life. If I told you you had $10,000 to invest in the stock market, how would you do it? Would you only buy when the prices dip? Or would you break that 10,000 into pieces and invest the same amount every month, regardless of what the prices are? Which way is better? Let's find out. These scenarios are two different methods investors use to buy stocks. The first one is called timing the market. The second one is called dollar cost averaging. Let's start with the first. Stock prices fluctuate all the time, non-stop, up and down, up and down. Timing the market is when you try to predict how those stock prices are going to move and use that as a basis to buy and sell. Sounds good, right? But here's the problem. No one can predict the future, and markets are quite irrational. There are a million variables, ever-changing global events, and mostly emotional people that cause the markets to swing up and down illogically. So the chance of timing it perfectly, maximizing profit and minimizing loss is pretty tiny. And imagine the stress associated with constantly watching these crazy fluctuations every minute of every day to try to predict just the right moment to move in or out. Yeah, no. And I haven't even brought up the fees and taxes you rack up that come with continuous trading. Now, someone might say it's worked for them before, but how much of that success was luck? You don't want to operate on luck. You want consistency. You don't want to luck out with one stock and then lose it all on the next trade. So what do you do then? The secret to creating long-term wealth is focusing on time in the market. Let the quality of the asset and the power of compounding work in your favor. Historically, the longer you hold your stocks, the lower the chances are of you losing your money. If you try to time the market by sidestepping recessions, you can end up hurting your returns. Take a look at this chart. The red line shows the growth of $1 from 1980 to 2019. If you bought US stocks at the official end date of recessions and sold them at the official start dates, a $1 investment becomes $31.52, which equates to an annual return of 9.3%. But if you'd simply bought and held those stocks over the same period, your dollar would have grown by 11.8% per year to become $78.31. That's a significantly higher return. If you think that made a difference, check out what only a few days out of the market does to your returns. Let's say you invested $10,000 into an S&P 500 index fund from 1980 to 2018. If you missed the best 5 market days, your overall return drops by 35%. And it keeps getting worse from there. The more good market days you miss, the worse the results. Missing the best 10 days will more than half your long-term returns. And guess what? The majority of these best stock market days throughout history have come in the middle of significant market downturns, like the 2000 tech bust or the 2008 Great Recession. Okay, so you decide not to try and time the market. What else can you do? One other strategy investors use is called dollar cost averaging. What is that? This investment strategy is sort of opposite to trying to time the market. With dollar cost averaging, you invest the same amount of money every month, for example, regardless of market conditions. This can be a much less stressful approach, especially when markets turn volatile. Let's walk through an example of dollar cost averaging to understand exactly what it is. Say you've allocated $200 every month to buy shares of the Cheesecake Factory. The first month, each share costs $100. So with your $200, you get 2 shares. The second month, the share price drops to $40. So now your $200 will buy you 5 shares. The third month, let's say the price goes back up to $50. So now you've bought 4 shares. Overall, you purchased 11 shares at an average price of $55 per share. If you'd invested all $600 in the first month, then you would have only bought 6 shares for an average price of $100 per share. So this method helps neutralize short-term volatility and also helps you avoid a poorly timed lump sum investment. Also, if you're enrolled in a dividend reinvestment plan, those regular automatic contributions are a form of dollar cost averaging. You're automatically buying more shares with those dividends regardless of what the price is. Now, there is also a third strategy that some investors use, and that is called value averaging. It sort of works like dollar cost averaging, but the difference is the amount of money invested each month. Here, the aim is to invest more when the share price falls and less when the share price rises. It's like waiting for a good sale before spending the money. So, with this strategy, you'd invest $200 in the first month. And let's say the goal is to increase your portfolio by $200 every month going forward. So in your second month, your portfolio should hit $400. Now, when you get to the second month, you find that the assets have grown to $250. So all you need to add is another $150 to hit your goal. In this case, since the share price went up, you bought less shares. If the opposite were to happen, let's say the portfolio value went down to $150. Then you would have bought with $250 to hit the goal of increasing your portfolio by $200 every month. And in this case, you would have bought more shares at a cheaper cost. So you tune it more based on how fast your portfolio is growing and what your goal is. Hopefully that all made sense. It's much easier to understand once you start doing it yourself and seeing how the markets move and react. Just remember, don't fear recessions and crashes. Understand what you're buying and how you're buying it, and always go with whatever strategy works best for you. Which method is your favorite? Let me know in the comments below. And if you enjoyed this video, please hit the like button. If you'd like to see more, make sure to subscribe to the channel and click the little bell if you want to get notifications. Thank you for watching and have a great day.